Welcome back to the second session. This session will be well, the mirror, perhaps a mirror image. There's a lot of elements shared from the first session. In the first session, Luba Peterson from Simon Fraser talked about the arguments for increasing the inflation target from 2% to something higher. This is going to be the opposite. We're going to be revisiting the idea of perhaps of price stability, zero inflation. This, for many people, this might be an exotic idea, but of course, for centuries, price stability was the rule and not the exception. A British reader of Great Expectations and Pride and Prejudice would have found that the money amounts in were exactly this, had the exact same interpretation to them as they did to Charles Dickens and Jane Austen. So price stability, low inflation has been seen, and it's might actually be a good idea. We're going to be having Thor Koeppl from Queen's, who will be making the presentation, followed by Bill Robson of the C.D. Howe Institute. And I think we're ready to go. So, and the same thing as before for questions. Just leave messages in the chat box, and I will get to you when at the end. And Thor, I think it's we'll give you the main floor now.
Perfect, excellent. So let me share my screen here. Okay, great. So as Steve and Chris already said, Steve said already, I will present exactly the opposite case, not raising the target but lowering it. And Steve already mentioned that it's not really something that's on many people's agenda to discuss this for the renewal of the target. But I think you can view it, my presentation, in one of two ways. One way to view me is basically as the devil's advocate here, if you want to, or the other view is you could view me as the moral authority at the end of the day, if you want to. We had already a very vibrant discussion, and I think a lot of the points that have been already raised and discussed will reappear here quite naturally. I think that's clear. It is also great to have later Bill Robson as my discussant, because as you will figure out, I will present the case very much from an academic point of view, from an academic angle. And Bill's going to come in later then and take a more practical view, which is also, I think, very, very important. So let's just jump in. I warned you, it's going to be a presentation very from the academic side, but it's going to be a bird's eye view. And the reason for doing that is because the organizers told me to basically being inclusive and trying to break the arguments down so that basically everybody can understand it, academic or not. So the starting point, my departure point here, is really about thinking, how we should think about optimal inflation. And the first insight that you arrive at when you think about optimal inflation, what is optimal in terms of the level of inflation, is that there's a lot of disagreement. And so what I've done here is I went on the internet, and there's a nice database running by Dirks, which is an economist at the Federal Reserve Board, that has gone back in time and looked at many, many studies and tried to figure out what these studies say about optimal inflation. So the first graph that you see here on the slide shows on the x-axis the publication date of the particular study, and reports on the y-axis then what the study actually has found in terms of the optimal level of inflation. Now you might wonder what the size of the circle means. It's kind of a crude measure of importance of the study, because the larger the circle, the more recognition this study has received in terms of the citations by other papers, okay? So if you look at this, this is a picture that goes up to 2009. It's kind of zero as a focal point here, zero inflation, but there's kind of a downward bias. So we're thinking about inflation as centered around, not centered around zero, but basically biased downwards into negative territory, which means deflation. Now, these studies vary in terms of the answers because they emphasize different channels. And not surprisingly, maybe, this picture has changed over time. So if you look at the picture again a little bit later, over the last 10 years, we're still kind of centered around zero inflation, but somehow the downward bias is gone. And it's now much more balanced in terms of upward deviations and downward deviations. So what I try to do now is give you a departure point for my discussion. And so we'll start out with my benchmark. And if you think about it, I think still we have to take into account what the Bank of Canada's goal really is. And the Bank of Canada's goal is first and foremost price stability. And it was good for myself when I basically wrote this paper and reviewed the literature as I was asked to do on having a low inflation target, is to go back and brush up on what the Bank of Canada officially states about price stability. And I quote here from the Bank of Canada: inflation, so price stability means inflation that is low enough so that it has no longer a material impact or effect on people's economic decisions. Now, if you're an academic, you immediately recognize this statement and jump to a big hallmark of monetary economics, which is the Friedman rule. So the Friedman rule basically argues that you should bring the opportunity cost of money to zero, because the opportunity cost of holding money is essentially the private cost of holding money. And why is that the case? Because you want to equate the private and the social cost of holding money, and the social cost of supplying money is essentially zero. Okay? Now, what does that imply? Well, the Friedman rule implies that one should have zero nominal interest rates. Why is that the case? Because usually other assets have a positive nominal interest rate, and people will be not willing to hold too much money or a lot of money because they would like to earn interest on their investments. And if you can think about money as a financial asset, which it is at the end of the day, it would earn a lower rate of return than other comparable risk-free assets or other assets that people are going to hold. So the Friedman rule then requires zero nominal interest rate in general on any risk-free investment, because money also pays a zero nominal interest rate, and consequently people would basically be indifferent between holding other risk-free assets and money. Okay, now you might ask yourself, what does that have to do at the end of the day with inflation? And so Mick already said there's one equation that nobody really understands in the general public. There's a lot of debate among economists as well, that we scratch our head how to interpret the Fisher equation. And Mick has talked about that a little bit already, but the easiest way, that's the only equation I'm going to put up there, maybe the most difficult equation. So the Fisher equation links nominal interest rates to the level of inflation, okay? So IT is the level of nominal interest rates, RT is the real interest rate, and pi t is the inflation rate. So if you have positive real interest rates and you plug in zero nominal interest rates, it will imply immediately that you're going to have a negative inflation rate here that is consistent, to be consistent with the Friedman rule, and that would actually mean that you would have to run deflation. So this is an initial discussion to basically bring everybody on board with the Bank of Canada's goal, which is price stability, and how to interpret that really from an academic perspective, which is the Friedman rule, and this has implications for the optimal inflation rate that would be actually negative, not even zero, but negative, okay? So the rest of my talk today is going to be about the following question. If we have established that as a benchmark, the question then becomes, should we really deviate from the Friedman rule? And I'm going to give 4 arguments here, and you will recognize them because some of these arguments have already appeared in the first session of today. And again, I will spare you a lot of the details on this, but I just basically going to present a summary of these 4 arguments, why we would deviate from deflation or the Friedman rule and have higher inflation. Okay, so let's jump right in. The first one is kind of a more recent question that we have asked here, especially if you're doing payments research. The question is actually, is holding money really costly? And is there something fundamental of zero nominal interest rates? Okay. And so what I've done here is I went out and got some data. It's very hard to get data on detailed data on figuring out what the cost of holding money is. So what I did was I plotted here the overnight rate against the spread. The spread is really the overnight rate minus deposit rates. And what you see here is really in this group picture that there's a one-for-one relationship. So that means if the overnight rate, the rate that the Bank of Canada sets for nominal interest rates as a benchmark at the end of the day at the very short end of the yield curve, is one-for-one related to basically the spread between deposit rates and the overnight rate. That means deposit rates don't move. That means you really have a higher cost of holding money and leaving cash, holding cash or leaving cash in your deposit account to make payments if the overnight rate is higher. So that means kind of that the Friedman rule is still relevant. Kind of quite interestingly, this goes back, however, to an argument that I think David Andolfetto, first made very strongly, of saying that, well, if you could pay interest on money, there's nothing special about the Friedman rule and having basically zero nominal interest rate and deflation. And I think one has to keep this in mind because as a payment economist, being a payment economist myself, we're going through a revolution here that means we can actually charge interest rate on money and possibly even negative interest rate on money or cash. If you think about central bank digital currency, but definitely we could also pay positive interest rate on cash or digital cash or deposits then by extension. But for now, I think we are not quite there. So I would argue that the Friedman rule is still relevant here. Excellent. We can come back to this in the discussion because I think it's an important topic. The second argument then I want to go down to is simply the welfare cost of inflation. And I think Mick in his discussion came already up with this point that we have to be careful what we are talking about. The cost of inflation are small if the range of inflation is very low, okay? We have also not a lot of variance in inflation if the level of inflation is very low, but cost of inflation tend to rise very rapidly. And there's a key question is when they start to rise very rapidly. But for now, I want to just leave it there and say like, well, if you talk about really 0% inflation or -% deflation, with a 2% inflation, the welfare costs tend to be rather small. Hence, we can actually then engage in a discussion that there could be a trade-off if you look at the cost of inflation with other costs potentially. And the literature has really focused on two main arguments here. One is basically a tax argument. If you think about inflation, inflation is just another tax, different tax than income tax, wealth tax, capital taxes, and so forth. But what the literature almost unanimously has found is that inflation doesn't have any advantages over taxes and definitely not disadvantages over taxes. So it's better in general to raise taxes on other things than on real balances of people or on money, if you want, unless the tax base of these other instruments is limited. And in Canada, you really can't make this argument very strongly because we don't have a big shadow economy where inflation would be an alternative to tax people more broadly. Or you could not make the argument either that the Canadian dollar is a big reserve currency, so you would basically tax other people that are not Canadian citizens here, like for example in the US, maybe make this argument. So that leaves us again with the issue here that it doesn't give us much leeway to deviate from the Friedman rule, so to speak, either. The second point is menu costs. And if this is an old argument, the traditional argument, that it's not easy basically to raise prices and it's costly to raise prices. So that would also basically apply to the counter argument to decrease prices. So there are costs to adjust prices in general. And somehow that causes zero inflation to be a focal point. Now, personally, I think this argument is very weak, especially if you think about modern economies where we are moving more and more to online shopping and so forth, where you actually have a lot of price discrimination, a lot of particular adjustment in prices. And as I said, from a practical perspective, Bill's going to come in here as well and probably talk more about this particular point, okay? The third argument, and I think that hasn't been raised very much yet, is that inflation is mismeasured. And so the key argument here is that the CPI that we use as an operational target in Canada tends to overstate inflation. So if that's the case, and we basically run so basically, if you look at this operational target, if we have 2% inflation, we actually are much lower potentially, and are with 2% inflation much closer to the Friedman rule than you would think. So if we think about menu costs, bringing the inflation into a range in terms of discussion between 0 and the Friedman rule, which means a deflation by 1 or 2%, this mismeasurement would push up actually the range of inflation into positive territory. Now, the first question here is, of course, how big is this bias and where does it come from? So first of all, the bias comes usually, people say, from quality adjustments, that better products tend to be more expensive, and we pick up better products in the CPI, if we think about that. So we are not comparing apples with apples, but apples with oranges. But this bias, if you go down, and I have a lengthy discussion in my paper about that, is rather small. It actually never, ever reaches the 2%. And people actually argue that's much lower into the range of maybe only 0.5% if you look at some studies that are made for Canada, for example, by Alexis Christophe, who works at the Bank of Canada. Okay. Quite interestingly, this upward bias is kind of important because households tend actually to have an even higher upward bias in their inflation forecast. Larry Shambridge just gave a recent talk, and in his speech, he pointed out that the bank is looking at that and pointed to several explanations for that, and why people's households, especially, perceptions of inflation is so much higher at the end of the day. One could be a perceived quality bias that's even larger than the overstatement of the CPI, but there could be other reasons in terms of that households react to factors that are not really directly in the CPI and so forth. Now, why does that all matter? Okay, and this is kind of the elephant in the room. The Bank of Canada really needs an operational target. Okay. And it needs to use, ideally, an index that matters for the policy decisions. Now, that's a big question because this ideal index is clearly model dependent. So if you work with a different model, for example, you take sticky prices, then you basically should target an index and get 0 inflation in this particular model as the ideal focal point and the optimal inflation target on the prices that are actually sticky, for example. But it's more important also to take into account that we have to be very, very careful, because the big achievement of the Bank of Canada is actually that it can control inflation expectations. I think that has already appeared in the previous discussion. I think that's the biggest benefit from the inflation target, that you have actually very, very well anchored inflation expectations. Sometimes people say they are too well anchored. I disagree, actually. That's a big effect. And so if you think about this from inflation being mismeasured and potentially being a danger here that inflation expectation could be unhinged and not be anchored that well, that would just mean we shouldn't fuss around with the inflation target at all. If at all, we should lower it maybe to strengthen this effect. Or if there's any mismeasurement and it's relevant for policy, then why not go out and design basically a better index for guidance and as the operational target that you can communicate clearly to people, rather than just accepting a higher inflation rate, basically pushing it up from 0 to the current target 2, or even go higher than that if you believe that the mismeasurement bias is more severe. Okay, I spend a little bit more time on that because I think we haven't covered that in detail yet. The fourth argument is actually the argument that, in my opinion, is front and center in the discussion about raising the inflation target. So I need to spend some time here maybe to give a counterbalance in terms of the argument, and some people have done this already, but it goes very much back to Tobin's expression for Christian de Ville in 1972, in his paper in 1972, and I combine this with the more modern version, which is going to be on the next slide. So the argument here is really that what the Bank of Canada trying to do is aggregate demand management. And even if you don't do active aggregate demand management by moving nominal interest rates around, you could say that in general, nominal wages are downwardly rigid. If you believe that, then they can go up, wages, but they never can really go down if you're an extreme proponent of that particular tenet or hypothesis. What then positive trend inflation can do is it actually can cause real wages to adjust when you need it, because when the economy is doing well, they go up. But if the economy is doing badly, they can't go down. So here, inflation is gonna help you. Now, again, I think that wages tend to be more flexible than we think. I just heard some news from Germany today, some statistics that actually nominal wages fell quite significantly in the current pandemic, about 5%, which is actually quite interesting because we think that wages and profits should both basically take a hit. And if you think about 50-50 or 2/3, 1/3, we're very close to having actually more flexible wages than we think. On top of that, in other times, we see a lot of turbulence in employment, and job-to-job transitions are usually also go hand in hand with wage adjustments here. The other argument, which is also important, that some serious quantitative studies that have gone out there and tried to estimate this from a structural perspective, where they used actual models that had rigid nominal wages, have found actually a very small degree of nominal wages. I think Francisco is here. Francisco Ushmercia has several papers on that. And if you look at them, he basically does it without the zero lower bound, does it with the zero lower bound, but doesn't find a lot of effects in that area. Okay, so I said this is the 1972 version. If you look at the 2020 version of Greasing the Wheel, and I think Narayana made this very clear, I think what we actually want is the Bank of Canada wants to react to big shocks by significantly reducing real rates. And that's what I mean by managing aggregate demand here. And if you think about this, what you want is actually inflation expectations is a fairly anchored at a very high level, so that you could move nominal interest rates down. It's nothing else than the Fisher equation and an expectational firm with sticky inflation expectations, so that if you have a particular if you need to engineer a particular real interest rate that is sufficiently low, what you need to do is basically have high enough average inflation, which goes along with a relative high average nominal interest rate, so that if inflation expectations stay sticky, you can bring the nominal interest rate down significantly, so that you have a significantly real interest rate and can basically engineer at the end of the day a very strong response of the real economy to these negative real interest rates. I think Luba also said in her comments, you can do potentially the same thing if you could charge significantly low negative or significantly negative interest rates. You can get the same effect even with well-balanced inflation expectations that are much, much lower. I show here some pictures that I took from a Gali and Andrade paper. And what you basically see here is exactly, and that's kind of important. I don't know how I'm going to do in terms of time here. I'm pretty much out of time, but that's my last slide before I'm going to wrap up. But the idea is really what these authors have done is basically turned everything upside down, in a sense that you basically have here a steady state real interest rate. And what you really want to do is you want to infer the optimal interest rate target or the optimal inflation target, in a sense that you basically set a nominal interest rate target in the long run, so that once inflation expectations have been basically anchored at that particular time, you can create enough stimulus in the economy from reducing the nominal interest rate with the sticky inflation expectations. Okay, good. So that's the 2020 version of Greasing the Wheel here. So I said a lot already about that. I'm not a fan of this argument, and I just to bring it to the point, I use a quote by Steve Williamson that I think sums it up very well. You know, the argument is like wearing a sweater in July. You can always take it off if you want to cool down. So it's a little bit phony. I think the more sophisticated argument is three good news stories. Number one, I think you have to look at it from a trade-off perspective. One trade-off here is clearly, you have to look at it, how costly is a higher trend inflation versus how often are you likely to hit the lower bound? And that's the trade-off. And if you look at some contributions to the literature, which have been done before the pandemic, of course, that have actually shown that there is nowhere a strong case, even if you subscribe to new Keynesian models and so forth, to basically go out and significantly raise the inflation target in terms of this particular trade-off and calculation. Also, I think there's little sign of falling inflation expectations, because some people say like, well, the biggest worry would be if we really have a deflationary spiral. They're incredibly well anchored. I think that's important to understand. Also about not fussing around with the inflation target. And finally, we have policy alternatives available at the lower bound. I think personally that forward guidance is limited. Quantitative easing has a bigger impact. Ben Bernanke has published his AER TRES in the AR. His recent paper has kind of shown that you can engineer up to -2, -3% negative real interest rates if you're at the zero lower bound. And maybe future developments, even though I'm not the real fan of it, could lead to negative interest rates that's going to be charged. And I think we have to talk about the implementation. And I think some papers are a little bit lukewarm about that and have shown that it can backfire if they go too negative. But bringing everything to the forefront with these new tools, I think can actually engineer sizable negative real interest rates if we need them. So let me sum up and make some recommendation here. The summary, I mean, Steve asked me for a summary slide that you could possibly use to summarize everything at the end of the day or at the next day. So I turned myself into, like, even though I'm an economist, not a business school guy, into a business school graph here to show it to you on a simple diagram. So these are the arguments that are out there. If you start out with the Friedman rule, you basically just used an arbitrary number here, -2%. That's how we started out. Payments technology might allow you to go higher because of any other argument. And then we had this the first argument against the Friedman rule. And then there were three other arguments here: the Manius argument, measurement issues, and lower bound that pushed it all higher. And I gave you arguments against that again kind of push us down. And the one is the online argument. Online prices, menu costs are really little nowadays. You could design a better index. There's alternatives at the lower bound that all draw is actually below the 2%. And I think that sums up my roles as the devil's advocate here. And if you want me to play moral authority here is, I think the Friedman rule is still alive and well. I think we may have to go to a modern interpretation that might be a benefit, but also we have to think about that against other arguments. Nominal rigidities and optimal taxation give little reasons, I think, to deviate significant from the inflation target and point us downward in terms of the inflation target. Measurement bias is not a good argument, and I again refer to my paper if you want to know the details in terms of the review. I think the lower bound problem should not be an excuse for suddenly doing nominal interest rate targeting. Once the real rate moves around, it goes up again, then we may have to lower the inflation targeting again. I think that's a bad policy prescription. Steady as you go is good, and we should anchor inflation expectations. And we have alternative policies available that are still an alternative and are being used as we speak and show some impact apparently. And so that would also give an argument of relying on them and draw us closer to zero inflation. And that explains it, why I said, why not 2% or below? Not arguing for the Friedman rule, but maybe we should have go back to the original discussion about price stability and be closer to zero inflation, that may be 2% and not a symmetric target. And that's it. Thank you.
Okay, thanks, Thor. A discussion is going to be done by Bill Robson of the C.D. Howe Institute. We're good.
Thanks very much. I am just going to see if I can get my slides up there. And thanks very much. Well, Steve, thanks for the introduction. Thor, very good paper. And hello, everyone. Sorry we can't be together in person, but this is much better than nothing. So it's great to be here. I'm going to say a number of positive things about Thor's paper. Let me just give you sort of the overview of the presentation, if I can advance the slide. I thought I would be able to advance the slide. Let's see if I can do that. There we go. So in the time-honored tradition of giving you the overview, Thor had a nice summary at the end there. But if I take you through what I saw as the key points of the paper, it will help to set the stage for me to elaborate agreement on 3 points that I think are really critical and maybe a bit contentious. One of them has to do with the flexibility of prices, to do with menu costs. Flexibility of wages, Thor touched on this, and it's really central to a lot of the arguments. And then this fear of a floor under the overnight rate, in the Bank of Canada's case, the policy rate of central banks. Having touched on those things, I want to make a comment that's a little bit in a different direction, harks back to the first session on why people like currency to hold its value. And then finally urge, sort of, as I see, complementary to Thor's recommendation, that we shouldn't make any change that doesn't enhance the prospect that our currency will hold its value. So in the time-honored tradition of discussant summarizing the paper, I hope this will be useful. What Thor does is he looks at the literature and he sees that there was, previous to the 2000s, this mode of zero on the recommendations for where inflation should be, but with some downward skew as a result of this distortion to do with the cost of holding money. And then when he looks forward from that, he sees that there is, again, a mode of zero, but there might be a bit of a skew upward. And as Thor takes us through that in the paper, the reasons that gained weight in the literature and tended to move the potential target up had to do with the available transactions money that bears interest. Also the idea of balancing seniorage, the inflation tax, against other distortionary taxes, minimizing menu costs, the upward bias in measured inflation, potentially inflexibility of prices, inflexibility of wages, and this potential floor under the policy rate. Having heard Thor's presentation, I'm not sure I have disposed of his arguments or summarized them quite adequately with these little symbols here, but in interest-bearing money, he acknowledges that might make deflation a less attractive option. Seniorage against other taxes, he was a bit more negative in the presentation than I understood him to be in the paper, but certainly it's not a very compelling argument. Minimizing menu costs, he's not a big fan of that, as he made very clear. Upward bias in measured inflation, yeah, like if your oven is giving you the wrong temperature, probably it's better not, instead of cooking differently, just to get yourself a better thermostat on the oven. I had an oven like that. Inflexibility of prices, again, the dynamic economy, the inflexibility of wages, doesn't find that a very persuasive argument, and he also argues, as you'll remember at the end very clearly, about the potential floor under the policy rate not being all that compelling. And as he concludes, he touched on this quickly, the Bank of Canada's credibility, stability of inflation being such a key consideration, because higher rates of inflation tend not to be so stable. And then he didn't touch on this in his discussion so much, but just this kind of concern that we might be overloading central banks, especially right now, with the macroeconomic tasks we want them to perform. So let me just signal in advance, I find the paper quite persuasive with respect to nearly all these points. And I hope it'll be useful for me to just elaborate a few of them to do with the flexibility of wages and of prices and wages, and in particular why I think there's limited justification in the real economy for raising the inflation target as a result of those things. And I also want to talk about the floor under the policy rate, because we've been there. It's not just a theoretical thing, we've been there. And I think we should look back to that experience. And then finally, as I said, I want to talk a little bit about money's value to people as a standard, particularly not just of a unit of account here and now, but standard of deferred payment over time. I think that's really important. So I come down to my sharing Thor's concern that we should really not do anything that's going to make the likelihood of money not holding its value any worse. And probably what, as a practical matter, that means sticking with the 2% inflation target. So that's my overview of it, which I hope was helpful. But the things that I wanted to elaborate here are, first of all, the flexibility of prices in a dynamic economy. And Thor referred to this already. I mean, there are plenty of places where prices change daily or even more than daily. Even when you hear the phrase menu costs, it kind of puts you in a mindset of a type of price setting, recording, advertising technology that's increasingly not all that relevant. And I remember in the early days of the Bank of Canada's inflation control program, coming home from a Bank of Canada conference and just seeing when I arrived home, there was a flyer stuck in the door where a major retailer was advertising 3,000 price reductions. And I just thought, you know, retailers like to advertise sales. They're a very important way of bringing custom in the door. And so you've got prices moving around all the time. Scanner data, there's a recent paper out of the US showing about 1/4 of grocery and drugstore prices changing monthly. If you work that out as an annual rate, it means a lot of things are moving around on an annual basis. And the other thing that I wanted to just mention as sort of a complement to that is the amazing churn in the economy. There are entry and exit rates calculated by Statistics Canada looking at firms, and between 2001 and 2018, you had firms entering and exiting. This is the percent of incumbents coming in every year versus going out every year. Happily, the margin is in favor, but this is more than 10% a year. Now, it may be that's a high level of churn, and some people might argue that maybe you could grease the wheels and have less destruction, but actually most people who've looked at these numbers over time have seen, and there's some effort to link them back further in time. This is one consistent data series from StatsCan that shows, in fact, that these rates have been declining a little over time, and for most people, that's a bit of a source of concern, that we might be having less dynamism in the economy, less entrepreneurship. But my key point here is that if you think about the implicit repricing going on in a situation where you've got this amount of firms coming in and out of existence every year, there's a lot more than you get just by measuring those prices, the same prices in the same outlets over time. Let me turn to a similar kind of discussion about downward wage flexibility. That's been a key point of contention, very much front and center in the initial discussions about whether the 2% inflation target or price stability was a good idea. We had early data, but they were very much dominated by collective bargaining agreements, often that had freezes in the first year. So it really made zero look like a very powerful number. Now, it probably is a powerful number because money illusion is important. Otherwise, inflation probably wouldn't be important. Thor cites a paper by Ellsby and Solon that shows that people keeping their jobs year to year, maybe 15 to 25%, would have nominal wage cuts. And I'd supplement that by, again, just looking at the dynamism of the economy. There's a paper out of the Bank of Canada showing that every month between about 0.5% and 1% of job holders switch jobs. That's every month. You've got 20 to 30% of unemployed people becoming employed and upwards of 3% of people experiencing job separations. I asked Corinne Liu, one of the authors of that paper, and just today she got back to me with a StatsCan paper that sort of summarizes the job churn data. 3% of the population switching from employment to unemployment or vice versa. And then if you stack on top of that, say 0.5%, 1% of people who are switching jobs every month, this adds up to a very large amount of churn every year. Is it too much? Well, maybe it is. There's the points that I just made. But if you look again at that same StatsCan database, you can see that there is an enormous amount of private sector job creation and destruction that's associated with this entry and exit of firms. And in fact, it has been going down a little over time. And again, sometimes people worry that there might actually be less, that the fact that there's less than there used to be could actually be a problem. But again, my key point, a lot of implicit repricing going on when you've got that kind of dynamism in the labor market. I don't see that in the models. And certainly if you're an academic or if you're in government, that would seem like a very shocking statistic, but that's the dynamic economy that we're in. And I think it argues similarly to the price costs that the variations in the rate of inflation in the range we're talking about, probably these aren't arguments that should carry a lot of weight. Let me move on to the floor under the policy rate and just make the key point, as I said before, we've been there. During the 2008, 2009, I should have said, I've got a typo here, crisis and slump, the overnight rate did hit 0.25%, 25 basis points, which is where the Bank of Canada says that's the effective minimum. And there's nothing in the monetary or macro indicators over that period that would signal the kind of implosion of the economy that a lot of people worry about when they think about the policy rate hitting some kind of a floor. And so what I'm doing here is I'm giving you a little bit of a test. Now, of course, there's a spoiler here because we know that the policy rate did come off the floor and that the economy didn't implode. But my point here is I'm showing this chart without the time scale, but the financial crisis is very much in the center of this. And here's the behavior of M2, the behavior of total business and household credit. It's in levels. So there's no issue of trying to interpret growth rates and the time lag of a growth rate. But the challenge would be, anybody who lived through it, when did the policy rate hit the floor of 25 basis points? When did it come off again? There ought to be a sag in these indicators if hitting that floor rate was really going to cause the problems of the kind that you see in these economic models. But you can't see any such sag in those data. I'm going to do the same thing again. Here we're looking at long Government of Canada bond yields. So there's inflation expectations built into that. Also the CPI, that's in levels. Again, because if you look at growth rates, you got a bit of a problem of interpreting the time lags here. With the CPI, maybe you can kind of guess when the crisis hit and what happened. Again, to spot here any kind of macroeconomic problem that signals that the policy rate was at its floor and that we were having problems providing support for the economy, you just can't see it. Finally, I'm going to go to the key macro indicators of GDP and final domestic demand, nominal dollars in levels. Now here you're going to be able to guess a little bit more easily when the policy rate hit the floor and came off it again, but not because there was a macroeconomic implosion, not at all. It's because it reacted to the slump in the economy and then came off the floor once everything was growing again, quite differently from what you would have seen if we had hit a dangerous floor. That's a bit of a teaser, so let me just put the money and credit indicator up again. There is the time scale. There's where the shaded area where the overnight rate was at, what the bank thinks of as the lowest it can go. And then I'll do the same thing for the long bond yields and the CPI. My point is, I mean, there's nothing in that period that would cause us to think that we were actually running into any kind of trouble, even though at the time, the models that we were looking at were saying this was a potentially very dangerous period at all. But by the time you hit the floor there, GDP and domestic demand spending is going up again, the CPI level and inflation rate are going up again. So I just think we've been there before. Now, maybe now is different and lots of things are different, but I think we would want to see much stronger evidence that there is a problem there before we tell Canadians, we're going to erode the value of your money faster because we're concerned about this thing that might happen, even though it didn't happen in the past. Now, I used that phrase about eroding the value of money deliberately because I want to emphasize that I think economic discussions and these models give much too little weight to the parallels between money and the role that it plays in people's lives as a unit of account and a standard of deferred payment, and the role of other measures in people's lives, such as meters and liters, tablespoons, fluid ounces, whatever you use day to day, degrees of heat, horsepower, lumens, you name it. All of these things play a critical role in our lives, and there's a big public good aspect to these weights and measures. If you ask most people, what's the right amount by which the central bank should increase or decrease the value of the money every year, what will they tell you? They'll tell you that it shouldn't increase or decrease at all, any more than they would want weights and measures, like should feet and inches get longer or shorter every year? Should pounds or kilograms get heavier or lighter every year? Economists often presume that people can effortlessly divide nominal amounts by some kind of index in order to get these real amounts, but people can't. That's why weights and measures are so useful. Even if feet and inches changed in a predictable way over time, building a house would be harder and renovating one would be worse. If cups and teaspoons and tablespoons changed all the time, cooking would be a nightmare. We take it for granted that the temperature that we read on our thermometers means the same thing now that it did a year ago, and that it will a year from now, and that the watts we pay for in our electric bills represent the same amount of electricity. Governments regulate these things because they have this really strong public good element to them, and money is exactly the same. I was interested, there's my little symbol for this. So if my words weren't persuasive, maybe these images will just make the point a bit more effectively. For most people, this is the significance of money. It's like a ruler, it's like a measuring cup, it's like a thermometer, and that's why they don't want it to change. I was interested looking at the Dirk's database to see that that data actually go back further than 1970, and the initial consensus in the academic literature for deflation equal to the nominal rate of interest was quite strong, but that idea didn't catch on. Inflation was chronic in the 1970s and people hated it, but they didn't want deflation instead. What they wanted was the value of their money not to change either way. And it's actually a relief for me to see in the database that that zero is still a fairly popular recommendation, because for non-economists, and going back to Luba's experiments earlier, it's really a uniquely attractive and easy thing for people to live with the idea that the price level will not change. Now, to summarize just in a practical sense, I would argue, as I said already, that we should not make any change that doesn't enhance the prospect of price stability as people have gotten used to it with inflation that has been low enough to ignore. I think that's one of the key things that we're seeing, including in the data, the flattening of the Phillips curve. People have really, in their day-to-day lives, stopped acting as though inflation is any kind of a thing to factor into their decisions. And we might be better off with a price level target. But I suspect, for the reasons that I just outlined, that the only price level target that people would kind of assimilate and think was reasonable and learn to live with easily would be a price level that didn't change over time. And I don't think there's any kind of a consensus at this conference or professionally among economists and central bankers that that's the way to go. But even more emphatically, I would argue against raising the target. I don't think that there's any reason to think that people would like inflation any more now than they did when we had it in the 1970s and the 1980s. And I think especially in these days when we've seen one pillar of macroeconomic stability in Canada, but not only in Canada, the pillar of sustainable fiscal policy seriously under threat. I think that central banks buying debt at the rate they are and raising their inflation targets would actually be quite frightening. There would be a big transfer of wealth. That got touched on earlier. It's worth emphasizing there are people with indexed pensions in the public sector who would be okay, and they're the decision makers. They'd be okay, and there'd be a transfer of wealth in their direction. I think for the rest of the population, it would be a very unhappy experience. And once people realized that they couldn't count on money holding its value the way other weights and measures do, and that policymakers were deliberately eroding it, they would demand a stop to it, as they have in the past when inflation got out of hand. We would go through another disinflationary episode, and that is really something that we could all do without. So like Thor, and for many of the same reasons, I would argue that if we are to change the target, we should do it in a way that increases the prospect that money will hold its value over time. Absent any realistic option for changing the target in that direction, we should stick with the 2% target for the CPI, keep working on a better measure of prices. enhance the flexibility and dynamism of our economy and ensure that the Bank of Canada has the tools and the operational independence to hit that target. So thank you very much. I hope I was within time. Thanks again for welcoming me to this conference, and I look forward to the discussion.
Okay, thanks, Bill. Okay, now it's up to question period. Once again, can you please, if you want to have a question, want to pose a question, let me know in the chat area, either privately or publicly. The first question is from Nick Rowe. If we could turn on Nick's mic, and Nick, you have to turn on your mic.
Have I managed to turn on my mic?
Well done, sir.
Okay, thanks. Okay, question for Thor. Only partly a rhetorical question, I think. Suppose the Bank of Canada decided to implement the Freeman rule and decided to do this permanently, and so this became the new rule for the Bank of Canada. As I understand it, the essence, the idea behind the Freeman rule is that people should be satiated in liquidity because it costs the Bank of Canada pretty well nothing, except maybe a bit of paper and ink, to produce liquidity. So if the marginal cost is pretty much zero, you want the marginal private cost to be pretty much zero as well, so that people should be pretty much satiated in holding money as the most liquid asset of all. How big would the Bank of Canada's balance sheet be in equilibrium if it implemented the Freeman rule? I mean, I'm trying to think if I would ever be satiated in liquidity. Other things equal, I'd want all of my assets to be more liquid rather than less liquid. Would the Bank of Canada own all the government bonds? Why stop there? Why not own all the corporate bonds as well, all the stocks on the stock market, all the farmland, all the houses? How big would the Bank of Canada be?
Okay, Nick. Hi, how are you?
I'm great, thanks. Great to see you and talk to you.
Okay, so good point. I mean, you explained it exactly right. I mean, the Freeman rule just basically says this. I mean, if the social cost of producing liquidity or liquid assets is zero, then it should be passed on to consumers so that consumers hold as many liquid assets as they need. Now, that doesn't imply necessarily that the balance sheet of the Bank of Canada is going to be infinite, or basically all the assets end up at the Bank of Canada's balance sheet. The first thing is, I think, definitely equity and definitely corporate debt is not the same as a risk-free asset. I mean, there are risk premiums associated with that. So I wouldn't throw them in the same boat as money. And possibly government bonds. Now, government bonds, we could regard them as risk-free at the end of the day as well. Let's leave it there. A good indication is the U.S., for example. I mean, the U.S. is a different type of monetary implementation regime than we have. We are converging maybe to it. The key difference is in terms of the settlement balances. I mean, we have zero settlement balances, zero reserves. Essentially, the U.S. has actually a reserve requirement. And the interesting part is, I think, as a payments guy, we understand very well what the Freeman rule means, because in the US, we had the Freeman rule essentially engineered by the Fed after the financial crisis with zero interest rates and excess reserves like crazy through quantitative easing. And that doesn't mean you have to basically saturate the market completely by absorbing turning all the government debt into basically reserves at the end of the day, or excess settlement balances at the Bank of Canada. Relatively small amounts were already sufficient actually to bring the cost of liquidity in the interbank market in the US actually to zero, and solved all the frictions that we saw there. And that in payment circles, we actually talked exactly about that. There was a great side effect at the end of the day that we said like, well, there's no friction in the payment system anymore. Great, perfect. So I think it's not a rhetorical question. The Friedman rule is alive and well, and we saw it that there's some benefit actually to make the cost of liquid assets very, very low. And it's not a contradiction by saying that would mean an infinite balance sheet by the Bank of Canada.
Thank you.
Nick? Okay, I don't see anybody else here. Well, as both Thor and Bill noted, a lot of the discussion for the lowering the rate is pretty much the mirror of raising, so it's probably not too surprising. So now we're going to just remind you, we did a poll at the very beginning. We're going to run the exact same poll, and just to see, who knows, maybe some people might have changed their minds.
Stephen,
Okay, so,
since there's time for a question, can I ask a quick one?
oh, all right.
Question for Thor. So the grease the wheels argument, 1972, was Jim Tobin and wage inflexibility downwards. Your 2020 version was the effective lower bound. So does that mean that you do not believe today that downward nominal wage rigidity matters? So that's a different argument than the effective lower bound, right? I think you could have one and not the other, or other and not the one. But you seem to be saying that in 2020, the wage rigidity argument isn't relevant, but it's the interest rate lower bound relevant that is potentially relevant. So can I smoke you out on that?
Well, you can. I mean, you can definitely. I mean, you're right. These are two different arguments. I connected them because at the end of the day, in the background, I think the elephant in the room is that you're going to do aggregate demand management at the end of the day by lowering interest rates. I think that's kind of the idea in its modern version of the 1972 version in terms of the new Keynesian model. If you put rigid wages in there, it's kind of identical almost to sticky prices at the end of the day, right? So you want to do aggregate demand management there. It's just a different version. Now, I think the 2020 argument is fundamentally different from that because it does not necessarily rely on a particular, how should I say this? It relies on having an impact with lowering nominal interest rates. So you must have a real effect. It's clear. But it doesn't depend one-on-one at the end of the day on downward rigid wages. So I separated the two, okay? So if you just take downward rigid wages, it's a quantitative question at the end of the day, how relevant that is, right? Now, the 2020 argument is a different argument because it's in general, can we have an impact? Are we losing an impact with aggregate demand management because we hit the lower bound? So you're right, at the end of the day, there's two separate arguments, yeah. But they are linked to kind of, you have real effects in the short run from monetary policy by lowering interest rates.
Okay, but let me ask it a different way. Do you think that the argument, I don't know what you felt about the wage rigidity argument in the early 1970s or 80s, but do you think the argument about the importance of downward nominal wage rigidity is just not that important today? Or is it less important today than it was, whatever, 20 years ago?
So personally, I mean, I'm not an empirical guy, that I have my own studies in my background. I think I get the feeling it's less important. If I mentioned Francisco's papers, I mean, they pin it at a very low level. Of course, they're for the US. You could argue they're higher in Canada. I mean, I think it is definitely not a key argument to raise the inflation target.
Okay.
I think it has gone down over time. I think labor markets have become more flexible. I mean, we're talking about the gig economy. We're talking about job turbulence, in a sense, a lot of job to job transitions that have become much more common. And in that sense, I think wage rigidity has gone down over time. I would think. I personally think. Yes.
Bill, do you have a thought on the wage rigidity today?
I don't know that it would have changed very much because I accept that there is an element of, I don't know if it's the right umbrella to use, but money illusion. I'm always struck by how as pension plans adopt flexible benefits, they seem to find that conditional inflation protection is acceptable to members when changing the base benefit would not be. You know, to most of us at this conference, that might seem a bit silly. I mean, you know, if you're 1% better or worse off, what does it matter which ledger it came out of? But people do demonstrate these proclivities. And the thing that troubled me a little bit about the argument about downward wage rigidity was that it was focusing on one type of money illusion and one area where people's reluctance to let go of the idea that money is, you know, kind of like a ruler or a degree of on a thermometer, and then you know, focusing exclusively on that as an argument for raising the inflation target instead of saying this is a cognitive thing for people that has much broader application, and therefore we ought to think about all the reasons why an unvarying price level or stability in the value of money over time would be helpful to people instead of focusing on this one area where it's not. I did show the measures of churn in the labor market, and those would indicate a little bit, and maybe contrary to what people worried about with inflation being so low, that though there has been a little bit less gross job creation and destruction over time. We know that there are measures of mobility geographically as well that seem to show that there's less of that going on. So maybe to some extent, the arguments in favor of worrying about downward wage rigidity would have gotten a little stronger, but I think they were very often made, as I said already in my discussant's comments, without looking at just how many margins of flexibility there are in the labor market and how much more dynamic it is than most of us think of day to day, or even when we look at the monthly labor force survey.
Okay, Angela Molino is now up next.
Thank you, Steve. My question is for Thor. I actually have two questions, but I'll only ask one. If we run out of questioners, I'll ask the second one, Steve. Thor, you know, you spoke a lot about the optimal rate of inflation as being lower than 2%, but you didn't talk very much about what the costs were of deviating from the optimal rate of inflation. I mean, when I looked at this several years ago, it seemed like that welfare curve was pretty flat with respect to inflation. And, you know, I don't remember the numbers, but as an order of magnitude, if we went from 2% inflation to 1% inflation, we would gain about, you know, 1 cup of Tim Hortons double every 2 weeks. So there wasn't a lot to be gained by going a little bit lower, and there wasn't a lot to be lost. Although it wasn't a symmetric welfare function, there wasn't a lot to be lost by going 100 basis points higher either. So have these studies that you've looked at, these quantitative studies, they provide numbers, estimates of what these welfare costs are?
Yes, of course they do. I mean, you can go back to the classical Lucas exercise, right, of measuring the welfare cost of inflation. I mean, that's what he did. And he comes up, you know, if we're in a range from, let's say, the Friedman rule to about 10%, they're actually minimal. You're correct. I mean, so, but that was actually in my presentation when I said, like, look, if we think it's exponential and very steep immediately, we're not even having this discussion. So we can have a discussion of deviating upwards to a certain degree, yes, because they are not very steep. Now, there are some more modern studies. I mean, Koeppl has revisited the argument, for example, by having a better measure in terms of the true cost of holding liquid assets and things like that, which have kind of put a little bit of a damper on the findings, original findings by Bob Lucas, right? So, but the magnitudes are not that extreme. Also, what people also not take into account sometimes is the volatility of inflation, which causes a lot of costs, okay? So now, again, this is minor if you would think in terms of a range, you know, 0, 5%. It's not going to be a dramatic change. However, let me put it like this. I looked at Luba's presentation and saw the New Zealand picture. When they changed the inflation target up by 1%, there were all these zigzaggy lines of actually realized inflation going up. So apparently there was quite a bit of volatility. And so again, I don't want to say this is strong evidence right now that, you know, changing the inflation target in Canada would cause the same spike, if you go upwards, the same spike in volatility of inflation, but I think I wouldn't dismiss it either. So yes, I think you're right. They are not traumatic, the welfare cost of inflation. They're still there, but that's why we have a discussion. If they were extreme, we would not have this discussion.
Okay. Angelo, did you say you had another question? There are people who are waiting just in case.
This is actually directed to Bill Robson. You mentioned the last time we went to the zero lower bound, you couldn't tell, and it wasn't a dramatic effect. And my own view was in the great financial crisis, when we hit the zero lower bound, we grazed it. I mean, we were up at about 500, 550 basis points, I can't remember, and we got down to 25, and there really wasn't the need to cut it much more. But this time around, we crashed into it. We were at 175. We couldn't cut more than 150. We didn't cut more than 150 basis points. So I would think that the experiences for the great financial crisis are not very relevant for what we're going to see now. And in particular, if I drew a graph of your money supply, you would really have been able to tell this time around when they engaged in quantitative easing what happened to the money supply when we hit that zero lower bound.
Well, yes, it is different this time, but I think that even that money supply figure tells you that central banks have tools that you don't capture just by looking at a model with the policy interest rate. So we are in slightly uncharted territory, but with the fiscal supports that we've seen, and also the possibility, I mean, we didn't dwell on that this time round, and it's an argument at the margin, but 25 basis points above zero is probably not as far down as the central bank could go. So I think that the other tools, as Thor has mentioned, and the possibility that the rate itself could go lower are important considerations before we decide that we are going to start raising the inflation target in order to accommodate this problem. I do think, I'll just quickly mention, since that's the whole point of raising the inflation target in the context of this conversation, that a lot of people probably feel right now that, having been wrong about the potential for all of the central bank support we saw over the decade after 2008 to produce inflation, that this time the concerns about inflation as a result of what's going on might be crying wolf. I don't know if it was before or after the previous session ended when David Andolfado was saying you keep monetizing at this rate and you're going to get higher inflation. I think that we'll see a very quick reaction on bond yields to that. And if you're of the school, this is a jump sideways from where we've been discussing, but to me, the gap between the policy rate and longer term interest rates is really a key thing in financial intermediation. If money is cheap at the short end and you can lend it out, and people's expectations of income growth or profit growth or everything else that's proxied in long-term interest rates are a good deal higher, then you're going to see money and credit creation. So I'm not as concerned as many people, even under the current circumstances, that central banks are going to run out of room. It is different, but let's see for sure that we got a problem before we start to raise the inflation target, because that makes a lot of other things happen as well.
Okay. Next is John Murray.
Just very quickly, a comment building on Bill's case for price stability. This is taking back to the 1950s. In the 1950s, there was quite an active debate of what was called at the time insidious inflation. And the idea was that at inflation rates of 1%, 2%, 3%, there was an insidious aspect in that people didn't focus on it, and it was quietly eroding their income and wealth. And we know from calculations that even at 2% inflation a year, our present target, prices would double through the magic of compounding every 35 years. And that's an insidious effect. So people like Alan Spurl, president of the New York Fed, who railed against this in the 50s, didn't argue for higher inflation so that people would focus on it, waste all sorts of time trying to protect themselves from it. But it was actually a fairly serious debate about the merits of a constant price level to avoid this insidious aspect of constantly eroding inflation. So I just thought it was really in the absence of any questions initially when I put my chat marker down that I thought I'd offer this, but I realize it's kind of off at the margin. But to Bill's more serious point, I think there is something quite fundamentally important about price stability And Bill's plea for a ruler of constant length and a weight of constant weight deserves more serious consideration. And I noticed its absence as an argument in the first session. That's it.
If I can just quickly weigh in, John, thank you. I'm glad you find it a persuasive analogy. I think I talked about the public good aspect of these things, and governments actually regulate other weights and measures quite ferociously. Scientists spend a lot of time focusing on things like the international prototype kilogram and trying to come up with measures of length using frequencies of light, for example, because and it doesn't strike anybody as odd that there would be such attention paid to making sure that these units of measurement are reliable. And I think that there are important lessons for money. You mentioned the 1950s. I will just quickly say, and I didn't check this, I guess I will after this conference. When do we start seeing pressure for wage and price controls? When does inflation become a political issue? It's true that it's not like an asymptotically worse welfare function after 2% or something, but people get unhappy about inflation at sort of 4 to 5%. It doesn't have to get to 10. It doesn't have to get to 20% or 1,000%. It's become a political issue in Canada and in other developed countries at lower rates than that. And I think that does testify to the fact that whatever we might think at this conference and whatever economic models might show, most people really do not like seeing the value of their money decreasing at such rates, and also unpredictably, as Thor said, because you do tend to see that greater volatility of inflation when the inflation rate's higher. So I think for a lot of people, that aspect of money is critically important, and it does deserve weight. Thank you.
You may remember, I'll just interject, at the end of the 1960s, the middle actually of 1960s, the US first introduced wage price guidelines because inflation had risen to 3%.
Thank you. Angela Vidish, you put a question in the chat. Do you want to ask, pose it here? Oh, you have to unmute your, there we go.
Okay, thank you. Yeah, I just, a different topic, though, one actually close to John's heart, I think. It's about the role of central bank digital currency in these discussions, right? Which I find very interesting, but I feel like, are we kind of 5 years ahead of where we would want to be talking about the importance of, or the options that would give us with respect to inflation targets?
I think, Angie, I'm coming in.
Thor.
So now we open up a Pandora's box. We could have a whole 2-3 more days on central bank digital currency.
I believe it's going to happen soon.
Exactly. I mean, it's right now it's a theoretical possibility. I mean, when I'm working on that now, I talk to people about programmable money. Can we program money in a sense to pay positive interest rates and get rid of the Friedman rule? Can we program money to punish people for holding too much liquidity or whatever of getting negative nominal interest rates and so forth? I think we are closer in terms of a possibility to do that, both from an economic perspective and a technology perspective. The issue is, I think we do not have enough confidence in doing it. Why? Because we don't know, I don't want to use unintended consequences, but we don't know what's going to happen. I mean, there's a big discussion what it's going to do to the financial sector. That's one of the big arguments. There's a big question of the transmission mechanism. We know when you go to negative interest rates, even without central bank digital currency, and that's the context we are talking here about, introducing central bank digital currency to engineer even lower negative interest rates than 0.5% or 1%. What we have seen in a lot of countries, like in Sweden, I just read a study, I forgot the author, that the transmission mechanism reverses even, apparently, after you hit about -0.5%, -1%, that suddenly there's no pass-through anymore, or there's weak evidence of the reverse pass-through from banks, actually, that they start raising interest rates, which is kind of a perverse effect, if you think about it. So I think it's not really the technological possibility, it's not really the economics per se, how to structure such a currency. It's more that you want to be careful to let this thing out of the laboratory, let's put it like this, and let it loose on the real economy, because we don't know right now in terms of exactly what the threshold is in terms of negative nominal interest rates whether they're going to do anything weird to the economy or the pass-through mechanism. And I think that's the biggest thing that holds us up right now in terms of a policy tool. Number one, to go to really significant negative interest rates, number one. And number two, to do have the technology ready, like with the central bank digital currency, to actually engineer that, to implement that in a serious way. I hope that
Can I just quickly weigh in to say that the discussion we're having now and a lot of others like it on this subject recently seem to be thinking about this as a tool of financial repression. And it would be quite effective if you could stop people from holding cash. But I think that context for the discussion, again, if I think of how that plays out in the broader public and think, who are looking at what's happening with fiscal policy right now, that would be a very unhealthy basis for a discussion about making everybody hold central bank digital currency instead of cash.
Okay. Well, we're at 4:15. Oh, Mick Devereux would like to ask something. Okay. Mick? Okay, can we free up Mick to speak, please?
Sorry, my unmute. I've heard a lot of this discussion about negative nominal interest rates, but just like Thor, I'm very, very skeptical of them. And I think just because we know there's a lot of money illusion there, we've seen that in the downward nominal wage rigidity. So the idea that people would see their bank accounts shrink persistently, I think that's just not going to work in an open society. I mean, this would be, I think, a very unstable situation. So there's something about the value of money being constant, and your bank account not you may not be getting a high rate of return, but at least it's there. It's not shrinking over time. So I think that just the public perception aspect of negative nominal interest rates is something that's very worrisome.
Okay, well, we're at the end of our time. I'd like to run the poll again, and then and after the poll, we'll do more questions for as long as people have interest in questions. So we'll just stop for now. We'll do the poll, and then we'll come back to questions. For example, I think David Endelfato would like to ask a question after this, and so we'll just do the poll again. Once again, only 3, okay? And the poll is open, so could you please, everybody do your check.
Stephen, am I correct in thinking that I'm not allowed to do the poll? Are you doing the poll?
I don't know. I think it made a noise when I clicked on it, so.
I don't think I'm able to do it.
I think I've been disqualified as well.
Wow. We got to
that
change.
Explains that. They don't know the results yet because it's fine.
I think because we're co-hosts. Oh no, there it is. There it is. Okay, there we go. Okay, now
I feel like a lawyer.
Oh, here we go.
Advocating for an option here.
It's very frustrating for people to suggest a modification to a resolution right in the middle of the voting, but the thrust of a lot of what we've been saying is that a target for the price level, especially zero target for the price level, is not at all like targeting nominal GDP. To the person in the street, targeting nominal GDP is a complete abstraction of no interest or significance, whereas an unchanging price level, that's dead easy to understand.
There's no street in this conference. Everybody's off the street.
It doesn't seem to be moving, so I'm going to close it.
Okay.
Last chance to vote if you haven't voted yet.
What do we got? What do we got? Are you going to show us from the morning or from the first one? There we go.
This is just now.
Okay. Oh, well, this time the status quo is moved up.
Interesting.
Yeah, well, we may have some people entering and leaving, so it's not necessarily a fixed sample here. Okay, David Endelfato had one last question. He said there's time, and I think there is, so let's go for it. David? Is he still there?
Everyone should be able to unmute themselves now. So if David wants to mute himself, he can.
There you go. So
Got it. Sorry, guys. Yeah, just to follow up on Mick's question, I too am very skeptical of the deeply negative interest rates for reasons that Mick said. I find it curious, though, that the main model that we use, the New Keynesian model, doesn't have these factors built into the model, which I find curious. And I wonder if we really are averse to negative rates, maybe we should build those factors in. I don't think that the lower bound imposed by physical currency is empirically relevant, given that the largest denomination is a $100 note, and we're talking about millions of dollars that would have to be taken out. So that's one thing, but there's something else, Mick, in terms of, I think you're right, the political economy aspects of this would be brutal, but I've recently written a paper that's kind of advocated this proposal by Gazelle about monetary transfers that have kind of an expiry date associated with them, and that kind of mimics, to some extent, the negative interest rate, in the sense that it promotes, if you don't spend the money, basically the interest rate is minus 100%. That might be one way to get around kind of the problems, the political problems of that type of policy.
And Steve Ambler, he would like to say something about maintaining the value of a dollar. Just a quick comment, Steve, then, I guess.
Yeah, I mean, if we're going for a rule that preserves the value of a dollar, then I think it's already started. The Bank of Canada is working on it. We better come up with a lot better price indices. $1,000 will buy you a lot more in terms of video, audio, and everything else now than it did in 1971, even in nominal terms. So we need price indices that take new goods into account and quality adjustments into account.
Okay. Well, I think we'll end up there. Just want to remind you that the links for tomorrow's sessions will be sent out tomorrow morning in separate emails. And once again, it'll be separate links for each of the sessions and the coffee breaks. The coffee breaks seem to work. I flitted in and out of the various rooms and discussions were going on, and I was very happy to see that. So we'll keep on that. You'll probably get an email this afternoon, and if I'm not mistaken, the videos will be available this afternoon. Yes, and this email, they will have, there will be links to the videos in case you missed anything, or if you want to look at something again or whatever. Anyway, we will have, all people who have registered have access to the videos, and that will be momentarily. Did I forget anything, Katerina or Nick? All right, well then, Kate, thank you. This is obviously an experiment, but it's gone much better than I'd hoped. So thank you all for participating. I'm very happy with how things went today. So hopefully it'll go the same tomorrow, and we got we have a barn burner for tomorrow. And I thought this would be kind of boring, just variations around what we have already. We got some pretty good discussions. Okay.
Thanks, folks.